Welcome back to the Daily Crypto Roundup. Today's crypto market is giving us one of those classic moments where the headline looks terrifying, but the detail underneath is far more important. Bitcoin is hovering around $60,500, up roughly 1.6% on the day. Ethereum is around $1,627, up more than 3.5%. XRP is sitting near $1.06. BNB is around $561, and Solana is one of the stronger movers today, trading near $76 and up more than 6%. So after a rough run, we are seeing a bit of green back on the board. But the big question today is this: is the market actually stabilizing, or are we just seeing a temporary bounce before the next major move? Before we get into it, this episode is sponsored by Kraken. If you are buying Bitcoin, Ethereum, XRP, Solana, or any other crypto, make sure you are using a trusted platform. As always, this is not financial advice. Only invest what you can afford to lose. But if you are active in crypto, we are giving away 20 XRP to anyone who signs up. Check out Kraken through the link in the description. Now let's get into the biggest story of the day, and it is all about Strategy, the company formerly known as MicroStrategy. The headline that grabbed everyone's attention is that Strategy has opened the door to selling Bitcoin under a new capital plan. And straight away, people hear that and think, hang on, is Michael Saylor selling Bitcoin? Is Strategy turning bearish? Is this the moment the biggest corporate Bitcoin treasury starts dumping on the market? But the reality is more nuanced than that. Strategy has authorized a new Bitcoin monetization program as part of its digital credit capital framework. In plain English, that means the company now has formal approval to sell some Bitcoin in specific situations. It can use those sales to build a US dollar reserve, support preferred dividends, pay interest obligations, and fund buybacks. The important bit is that this does not mean Strategy has suddenly decided to abandon Bitcoin. It also does not mean there is an immediate forced sale. What it means is that the board has given management more flexibility. The company can sell up to $1.25 billion worth of Bitcoin to build its US dollar reserve. That reserve is designed to help cover preferred stock dividends and interest payments. Strategy can also sell Bitcoin to fund up to $1 billion in digital credit securities repurchases and up to $1 billion in Class A common stock buybacks. Now, if Strategy raised the full $1.25 billion through Bitcoin sales, that would reportedly mean selling roughly 20,800 Bitcoin at current prices. That sounds like a huge amount, and to be fair, it is. But compared with Strategy's total holding of more than 847,000 Bitcoin, it would represent around 2.5% of the stack. So the market has to ask two questions here. Question 1. Is this bearish because Strategy is finally willing to sell Bitcoin? Question 2. Or is this actually a more mature treasury strategy, where the company is trying to manage credit, dividends, reserves, and buybacks without constantly issuing more common stock? That second question matters, because Strategy has become more than just a Bitcoin holding company. It is now a complicated capital markets machine built around Bitcoin. It has preferred stock, debt-style instruments, equity, reserves, and a huge Bitcoin balance sheet. That means investors are no longer just analyzing how much Bitcoin the company owns. They are analyzing how the company funds itself. And that is why this story matters for the wider market. Strategy has been one of the biggest symbols of corporate Bitcoin conviction. If the market believes Strategy is only ever a buyer, that creates one kind of narrative. But if the market now knows Strategy can sell in certain situations, even if only for treasury management, that slightly changes the psychology. It does not destroy the long-term thesis, but it does make the story more realistic. And interestingly, Strategy shares actually moved higher after the announcement. That tells you equity investors may see this as balance sheet discipline, not panic. The next big story is regulation, and this one could be very important for the second half of the year. The White House is expected to speak with law enforcement groups as it tries to push forward the crypto market structure bill known as the Clarity Act. This is all about one of the biggest unresolved questions in crypto. How do you regulate the industry without accidentally killing open source development, DeFi, and blockchain infrastructure. The tension is focused on protections for software developers. The crypto industry argues that developers who create decentralized tools should not automatically be treated like money transmitters if they do not control user funds. That is a crucial distinction, because if every developer can be treated like a financial institution, innovation becomes extremely risky. But law enforcement groups have concerns. Their argument is that bad actors can use mixers, tumblers, and DeFi protocols to move illicit funds, and that the bill could create too much protection for people building or enabling those systems. So this is the classic crypto regulation battle. The industry wants clarity and protection for legitimate builders. Law enforcement wants tools to stop criminals. Politicians are trying to write a law that does both. The White House appears to be trying to keep the bill moving, with crypto advisor Patrick Witt involved in discussions. Senate figures are also pushing for movement, with July being talked about as a key window. But the bill would need 60 votes in the Senate, which means it cannot pass with Republicans alone. It needs enough Democrats to come on board. And there are still major sticking points, including illicit finance, developer protections, the role of the Commodity Futures Trading Commission, and ethics rules around senior government officials having personal crypto interests. For investors, this is not just political theater. Market structure matters. If the US finally gets clear rules around which assets are securities, which are commodities, how exchanges operate, and how DeFi developers are treated, that could unlock serious institutional capital. But if the law gets watered down, delayed, or turns into another political fight, then crypto remains stuck in the same fog it has been in for years. Now let's talk about Tom Lee and Ethereum. Tom Lee says the recent weakness in crypto is partly down to quarter-end window dressing. That basically means investors are cleaning up their books before the end of the quarter. If an asset has performed badly, some funds may reduce exposure so they do not have to show clients they were holding too much of it at the wrong time. And that explanation does fit the mood we have seen recently. Bitcoin and Ethereum have both been under pressure. Bitcoin is reportedly down around 12% in the second quarter, while Ethereum is down around 25%. That puts both assets on track for a third straight quarterly loss. But here is the interesting part. While the market has been weak, Bitmine has continued buying Ethereum. Bitmine bought another 27,084 Ethereum last week, worth around $43 million. That brings its holdings to about 5.7 million Ethereum, which is around 4.7% of the circulating supply. The company is now closing in on its target of owning 5% of all Ethereum. That is a staggering number. Yes, the latest purchase was smaller than previous buys, so the pace may be slowing. But the fact they are still accumulating during a down market is important. This is exactly the type of thing investors need to watch. Retail tends to panic when prices fall. Treasury companies and institutions often use weakness to build positions. And this is where the Ethereum story gets interesting. The price chart looks ugly. Sentiment has been weak. But large players are still positioning around Ethereum as infrastructure. They are looking at stablecoins, tokenization, DeFi, settlement, research, scaling, and long-term network value. That does not mean Ethereum cannot fall further. It absolutely can. But it does mean the story is bigger than just one red candle or one bad quarter. Next, we have a major macro story involving the Federal Reserve. The U.S. Supreme Court has blocked President Donald Trump's attempt to remove Federal Reserve Governor Lisa Cook. The ruling keeps her on the Fed board while the legal process continues. Now, why does this matter for crypto? Because crypto is extremely sensitive to interest rates. Bitcoin, Ethereum, and altcoins all tend to perform better when liquidity is improving, when rate cuts are expected, and when investors feel comfortable taking risk. Trump has been pushing for lower interest rates, and this case became part of a wider debate about Fed independence. If a president can easily remove Fed governors, markets may start to believe monetary policy is becoming more political. If the court reinforces legal protections around Fed officials, then rate decisions may remain more insulated from political pressure. For crypto, that means investors cannot just rely on political pressure to force easier money. The The market still has to watch inflation, jobs data, Fed speeches, and actual policy decisions. So this ruling is not directly about Bitcoin, but it affects the environment Bitcoin trades in. And finally, let's talk about security, because this is one of the most important stories in crypto and one of the least understood. A new report says roughly $16.69 billion has been lost to crypto hacks, DeFi exploits, and bridge attacks, and around 40% of those losses are tied to stolen private keys. That is massive. The key point is this: a lot of crypto losses are not happening because the blockchain itself breaks. They are happening because private keys get compromised. A private key is basically the master password to a wallet. If someone gets it, they can move the funds. There is no bank manager to call. There is no reset button. There is no fraud department that can reverse the transaction. Whoever controls the key controls the crypto. This is why self-custody is powerful, but also dangerous if people do not understand the responsibility. Security experts are saying the industry has spent years focusing on smart contract audits, but attackers are increasingly targeting weaker operational areas. That means cloud systems, third-party tools, social accounts, internal processes, employees, signing systems, and key management. And this is where the industry needs to grow up. If crypto wants to handle trillions of dollars, it cannot rely on a single private key controlling everything. We need better use of hardware wallets, multi-party computation, account abstraction, social recovery, passkeys, multi-signature controls, and proper operational procedures. This is also why ordinary investors need to stop being casual with security. Do not keep large amounts sitting on random hot wallets. Do not store seed phrases in screenshots. Do not send private keys to anyone. Do not click wallet drainer links. And if you are holding serious money, take custody seriously. So what is the verdict today? The market is still fragile, but today's news is not all bearish. Strategy being allowed to sell Bitcoin sounds scary, but it may be more about balance sheet flexibility than abandoning the Bitcoin thesis. The Clarity Act shows US regulation is still moving, even if the politics are messy. Tom Lee's quarter-end explanation gives a reason for recent weakness, while Bitmine's continued Ethereum buying shows institutions are still accumulating. The Supreme Court ruling reminds us that macro and Fed independence still matter. And the private key story is a reminder that security may be the next major battleground for crypto adoption. So no, this is not a clean bull market moment. But it is also not a simple disaster story. This feels like a market going through a reset. Weak hands are tired. Institutions are being selective. Regulators are negotiating. Treasury companies are adapting. And the industry is being forced to mature. That is usually uncomfortable in the moment. But it is also how stronger markets are built. As always, stay calm, manage your risk, keep your coins secure, and remember, the biggest opportunities usually appear when the headlines are at their most confusing. Thanks again for listening. Make sure you're following the show, and as always, we will see you at the top.